What's up, everyone? My name is Eddie, and this is the Soaring Dividend YouTube channel, where we discuss dividends and other passive income investing. If you're new to the channel and get anything out of this video, please give me a giant thumbs up and consider subscribing if you haven't. In today's episode, we're going over my top 2 favorite high-yielding dividend-paying companies, and I'm talking about high yields such as 6 to 8%ers. High yielding can be different from each individual person, but do your own research on what you are more comfortable with. High-yielding stocks can be very rewarding, but they can also be seriously risky because as the yield goes up and up, the price goes down and down. So be careful when you invest in these companies and do your own due diligence and research. Don't just take my thoughts today and put them into action. Do your own research as well. All right, so these are my top 2 favorite dividend yielding stocks. They are EPD and EMV. I'm going to go over a brief analysis of each individual one and why I'm bullish on each one and see them in the long run. So without further ado, let's get to it. The first company we'll be talking about today is EPD, Enterprise Products. EPD is a leader in the energy industry, specifically within the United States. They specialize in crude oils, natural gas, and they're moving into petrochemicals as we speak. They know that the future is ahead of them and they need to be more renewable in terms of their energy sources. They can't just be strictly reliable on their crude oil system across the United States. They have to incorporate multiple facets so that they get multiple income streams. This company is very good at just that. Let's look at a more in-depth analysis of EPD, including their dividend portfolio, their financials, and a few other key things that I find them as a very bullish investment. All right, so let's take a quick look at EPD on Seeking Alpha, just to get a feel of what the industry is like. So if it suits your boat or not. So scroll down the page until we get to the company profile section. Here's going to go over the sector and industry that they're in. So they're in the energy industry and the storage and transportation of oil and gas. So they also process crude oil, natural gas, NGL, so natural gas liquids, and those are things such as propane and ethane. So they process the storage sites for those. I want to make a quick note that when people think of oil companies, they think of Chevron, ExxonMobil, these big hardcore brands that have stood the test of time for so long. But while most people think those are excellent investments, I'm a little bit weary of them just because I see their revenue diversification shrinking over time as we're getting cleaner and cleaner. And that's one reason why I like EPD, is that it's expanding into petrochemicals and it's expanding into more renewable sources. So I think it has more potential long down the road. And that's just my opinion, but I think that's something you have to look at when you address energy companies. And energy companies can be a very, very strong dividend machine if you give them the opportunity. Let's take a quick look at an article from Motley Fool. So I talked about some of the growth opportunities. So their expansion into petrochemicals. One thing we have to note here is that, as it says right here, the company spent $2.9 billion on growth projects in 2020 alone. They have spent $1.6 billion in projects from 2021 and $800 million of projects in 2022. So they're continuing to grow and grow their company, looking forward long down the road. That's the exact thing we want to see in one of these companies, and EPD is doing just that. All right, so along with their growth opportunities, I just want to give you a feel of what they are and where their systems are in place so you can get more personal connection with them. So let's head over to their system map. So this is a quick look at where their pipelines are located within the United States. And this is, again, just their pipelines and services. If you want to get a larger expansion of their industry, let's click select all over here on the left. And this shows all of the different elements to their business, such as natural gas processing plants, fleet facilities, marine facilities, and of course, their liquid and crude oil pipelines go throughout the US. And I have heard that they are expanding more and more into the northern region, and they might get more relationships with Canada along down the road. So I do feel like this is a company that's wide, diversified across the United States. So that is a good feeling that they're involved a little bit everywhere. All right, so this is going to be the actual fun part about this for me, exploring their dividends, because this is what the channel is about, not only looking at strong companies, but looking at the dividends behind those companies. So again, go to Seeking Alpha. You can type in EPD here, go to the dividends tab, scroll down the page until you get to the dividend summary. They have about a 7.8% yield. Their annual payout is $1.80. Their payout ratio is 90% about. So that's considered a relatively high payout ratio, but it is an energy company. So higher payout ratios are more normal. So if you see a 80 to 110% payout ratio, that's just more normal right now, especially during the pandemic that we're in. Companies rose their payout ratios to get more and more back to their investors to keep them in. All right, so they have a lower 5-year growth rate of 3%, but the attractiveness here is in their yield and their dividend growth. So they have 22 years of consecutive dividend growth. So let's take a brief look at how it's grown so far. Okay, so if we scroll down the page here, you'll see a max of the dividend history. You'll see it's growing very nicely over time. They have a couple splits here and there, and that's just showing that more and more interest is in the company and people want to invest more and more. So there might be another split in 5-10 years. We don't know, but they're going to keep paying us back as investors. Okay, so that's a brief intro of their dividends. You can look at a couple more different things, such as the yield over time, so that you get in at a relatively decent price. For EPD, I think anything above a 7% yield is an absolute gain. And as long as you're making, I would say between, let's see, if you could get in at around under their max pre-COVID time, so under $26, $27, that's a gain on my side. Because if you look over time, they've maintained like this relatively flat cycle since 2017. And even if it remains flat, you're still going to get those dividends and they're going to continue to grow and grow and grow. So that's an excellent price target for me. And I think you should consider. So that is the dividends portion of this. We're then going to go into a financial section. So let's check out the financials tab right here. We're just going to look at the balance sheet and the cash flows today. We're not going to go super in depth. So here's the balance sheet of EPD. Let's take a look at a couple of their things. So total assets is an indicator. As you see, their total assets is steadily growing over time, which means that they're investing more and more into tangible elements, such as more storage facilities for their gas lines, more pipelines. All right, that's exactly what we want to see. And usually when assets go up, their liabilities also go up for most companies. And so that's the case here as well. So their assets and liabilities are steadily increasing over time together. Neither one is majorly surpassing the other, which is great. If you saw liabilities outpass their actual assets, that could be a little worrisome, but I think this is fine. So let's scroll down the page a little bit more. Let's look at their total debt. As you see, their debt is increasing over time from about $27 billion in December 2019 to about $30 billion in December 2020. This is more normal. I would like to see them pay more and more of their debt off over time. And I hope that they do just that. And as we'll check out in the cash flow statement, cash from investing activities and cash from financing activities is a good indicator to see how much they're actually allocating from their profits back out into their debt line. So let's take a look at just that right now. So if you go over to the cash flow statement here, let's take a quick look at the operating cash from operating activities. So right here, their cash from operating activities has been at a quick decline since the pandemic, but I think it'll maintain relatively flat above the $5 to $6 billion range for the next year or two. But then they should grow more and more as they grow into more renewable energies. Again, from their cash from investing activities, you see that they're paying down more and more of their debt. And I wish they did this at a faster rate, but they have to pay us as shareholders back. So that is more reasonable, all right? Because us as shareholders, we want to see more and more dividend payouts and larger ones at that. So that's okay. Their net change in cash is a positive versus the previous year, 2019, as a negative 0.1. So $748 billion net change in cash. Excellent. And just to take a quick look at their free cash flow per share. Again, this avoids any dilution that the company might evolve into their balance sheet. So this is a great indicator to look at if you want to see a relatively stable company and their cash flows are returning to their investors. So as you see here in 2016, it's at 0.52. And now in December 22, it's $1.19. Again, this is a great indicator of something to look at in terms of if they're generating enough cash. So fantastic. And one quick last thing right here is their net debt issued. Their net debt issued has been increasing over time. So like we saw on the previous balance sheet, their debt is increasing. I think it was about $3 billion this past year, so since the pandemic. And this could definitely be a huge improvement point for the company to work down that debt. So that's something to look at long down the road, maybe in a year or two from now, once you have a position in it, make sure that they're doing these things to make sure that they meet your values as an investor. All right, so that's a quick look at their dividend portfolio, their balance sheet, their cash flow statement, and that is all I have for EPD. Let me know what you think of EPD in the comments below and if it suits your values. If not, then I have another great company I'll be introducing next. So let's get to that company. I hope you enjoyed my brief overview of EPD, or Enterprise Products. It's one of my favorite high-yielding dividend companies right now, and I'm continuing to reinvest and invest in that company. My second company I'm talking about is ENB, or Enbridge Inc. It is also an energy player, specifically in the upper parts of the United States and in Canada, more specifically. Before I continue, I like to say I am not a financial advisor. This is just for entertainment purposes only, and you need to do your own research in all these companies before you actually invest. Research, research, research is my 3 R's of investing. You never know what you do not know. So check out articles, right? Check out their financial statements, look at the value and intrinsic values that you have as an investor before you buy. All right, without further ado, let's look at ENB. All right, so the next company I want to talk about is Enbridge, ENB. So let's head over to Seeking Alpha to take a quick look at what the company is like. So they're very similar to Enterprise Products, the company we just looked at previously. They're in the energy sector, but they're primarily focused in Canada and the upper United States. So they operate in 5 different business segments. They operate in liquid pipelines, gas transmissions, gas distributions and storage, renewable power generation, which is the part that I'm really excited about, and energy services. They're in a very similar industry as EPD, but they're more focused in Canada. So this could definitely be a good international play if you want to diversify some of your investments into more international markets outside of the United States. The company's interest in transitioning more into renewable energy, such as wind and solar power, and I'll show an example of that in a second from their systems map, is something that I'm very excited about. And whether we agree or not, the world and its ecosystem is changing. So we need to adapt. And by we, I mean companies around the world and society needs to adapt to ever-changing flows in our ecosystem. That is bound to happen. So without further ado, let's check out their system map and we'll go from there. So let's quickly go over to their website here. If you go over here, you'll see that this is just showing their infrastructure, specifically their liquid pipelines. So they're focused in the upper region of Canada, and then they're spreading out downwards all the way to Texas. All right. And if this is just their liquid pipelines, if we select all here, this will show all of the infrastructure that they offer. So one thing I really like about this graphic is that you get to focus on just their wind and solar. So this is a brief overview of where they're targeting their clean energy initiatives around the United States and North America. So as you see, they have a bunch of clean energy down in Houston, all the way up to Edmonton in Canada, and then over to New York and Toronto. Let's look at a quick overview of where everything is again. And you see that they are all across North America. They're not just in one location. You can find a little bit of Enbridge everywhere. I actually live in upstate New York, and Enbridge is in my backyard too. My girlfriend, she also has Enbridge as a huge player that she participates with, and that they charge her for her gas. So it's pretty cool to have a company that's so close to home. All right, let's go back to Seeking Alpha to take a look at their dividend portfolio next. So let's go to dividends here. Scroll down the page, you'll see that they have about a 7% dividend yield right here. Their annual payout is about $2.60 right now, which is a great payout considering their price is only $37 a share. Their payout ratio, like I was mentioning earlier, is relatively high because it's an industry, like an energy industry during the pandemic. So it's at 126%. They're paying more and more of their net income back to their investors, and they're paying them more and more. So hopefully this goes down below 100 soon. And I think that will definitely be the case within a year or two. Another huge indicator why people love Enbridge is their 10% dividend growth rate, which means that over a 5-year period, they have grown their dividend at an average of 10% year over year over year. All right, that is a huge growth. And I'll show you an example of what that means in a second. They also have a 3-year dividend growth, and this is just the beginning. That seems relatively small right now, but the potential for the company is something that we can look forward to. Warren Buffett did not discover Coke right away, right? He got into Coke like 5 to 10 years down the road when it was already proven. So that is something we want to focus on here. Let's look at the future potential of Enbridge. So their dividend CAGR can also be looked at by looking at their dividend payout history. So if you see they had different amounts here on the right-hand side. So let's go all the way back to 2015. In 2015, they gave out a 35-cent share in November, all right? Now in 2020, they gave out a 61-cent share in November. This calculates to a 10% dividend increase or dividend spike from that 5 to 4-year period. That is basically how that dividend CAGR is calculated. I'll post another article and another link to one of my videos that I talk more in depth about these different metrics, but that is a brief overview of what it's like. So the dividend yield, dividend growth rate are 2 indicators that investors really love, especially dividend investors. Let's take a quick look at their financials. We're going to do their balance sheet and cash flows yet again. So let's double check their investing activities. So their current assets and total assets, more likely, they're pretty steady through the pandemic, which means they're not overspending and over allocating their resources to particular projects. They're having a more reserved approach. All right, that is respectable. And I see companies like this, and I'm just like, wow, they're not declining it too bad. They're not selling too many of their storage sites or pipelines. They're just maintaining until they can afford it, which is great. Liabilities, so total liabilities, again, relatively steady, just like their assets. And scroll down the page, let's look at their total debt right here. So in 2016, their debt was about $31 billion. Now in December 2020, it's about $53 billion. So their debt has increased from a 5-year time period about $20 billion. That is substantial. So one thing about ENB that we have to look at down the road is their total debt. It would be really nice to see the company pay this off more and more, but that's not the case right now. So let's keep being aware of it as investors to look at the debt of a company. So lastly, let's look at their cash flow statements. All right, so cash from investing operations. So the company earning money from their liquid industries, their gas transmissions, holding the storage centers for their ethane and propane. This is how they're earning their cash from operations. So as you see in 2016, they're at $3.8 billion from cash from operations. December 2020, they had a huge increase up to $7.6 billion. That is substantial for an energy company, and that's well above what EPD did. Again, cash flow from investing activities, they're buying more and more resources. So they're looking into more pipelines and looking more into renewable sources such as wind systems. I showed that in the systems map. Their financing activities, they're paying down a little bit more debt over time. Next, their net change in cash. Again, that's at a negative this year. And that's not too bad of what we want to see here. Again, as long as their cash from operations is in a plus and they're generating profit, that's really what we care about as investors. So lastly, we'll look at their free cash flow per share. As you see, their free cash flow per share is increasing over time. And right now it is about $1.47 versus 2 years ago, it was at $1.19. So it's steadily increasing. So they're not diluting their shares as much, and investors love to see this. All right, so that's a brief look at their cash flow and their balance sheet. And I just want to take a brief second here and tell you that this is a very bullish company right now, especially in terms of analysts' opinions. There are several articles on Seeking Alpha that I highly recommend you read. You get up to 5 free articles, so that's definitely a benefit. I just print as PDF and save them to my hard drive. That's pretty easy. You can scroll down the page to see their earnings per share. You can see more analytics down here. All right. So that is ENB. That is the last company I'll be talking about today. I hope you all enjoyed my brief analysis of Enbridge and Enterprise Products, two huge players in the energy industry, specifically in the liquid and gas pipelines. These are two of my favorite high-yielding companies right now, so I strongly recommend that you check them out. If you got anything out of this video, please leave me a giant thumbs up and consider subscribing if you haven't. I'm also going to leave a link to all the video articles and different system maps in my description below. So if you want, you can check them out there. Without further ado, I'll see you guys in the next one.